What's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to do some stock analysis for Monster Energy stock, ticker MNST. So this is the first we did some research on this company, and it's very interesting. For one, the stock is up 129,000% in the last 15 to 20 years, you could say. This stock used to be a penny stock worth only a couple pennies, and now this stock is $57 and a market cap of $60 billion. And all this company does is sell energy drinks, right? So let's look at a couple things here. If we look at their revenue, we are going to see that they grow at about an average of 12% per year. Last year, they did $6 billion, and the chart looks a little bit something like this. So very consistent. Every year, they're pretty much growing revenue. Everything, actually, in the last 5 years, it's up over 13%. So they're still growing, and everything looks good there. Net income averages about 7%. Last year, they did $1 billion of net income. And you can see that the net income went down a little bit over the last 2 years. But in the long term, the graph is very consistent, right? So I'm going to give that one a check. Even though that one's not growing as fast as revenue, though. That's the only thing. Because it used to grow at 13% per year, and then the last couple of years, it's kind of been slowing down. That's just net income-wise, though. Then we're going to look at the PE ratio. This is also an interesting one because it trades at a pretty rich valuation, on a normal basis. It's normally at over 30 times earnings, up to 40 or 50 times earnings. Right now, we're looking at a trailing PE of 42 and a forward PE of I believe 38. Yeah, 38 times this year's earnings. Let's see what they're doing revenue-wise. It looks like they're doing about 13%, 11%, anywhere around there for revenue. So that's still, I wouldn't consider that like a dying company. I would still consider that a healthy growing company. EPS going from 1.1, 1.5, 1.7. That looks good there. So that will get a check. That's going to get a check, but I wouldn't consider this like a fantastic time to buy or anything. If we look at the stock chart too, you can see that it's really not, it's not like it's had a huge dip or anything. Like it's still up there a bit. I mean, 38 times earnings, even on a forward basis, that's a lot. If I could get it at maybe 30 times earnings, that would be more interesting, but it's still kind of rich right now. Now, are they innovative? This one is kind of different because you have to think differently in terms of a drink company. The way they innovate is not, it's not like we're talking about Apple or Amazon in terms of innovation. So this way, for this company, I would look at it like they made drinks with no sugar. Now they're making drinks with alcohol. They added oat milk to some of their drinks. They're making coffee and latte drinks. So in the drink industry, I would consider those things to be innovative ways to keep expanding your business and your products. So that'll get a check. The next one I was very happy with, 36% market share. So we're going to look at some graphs here. We have Monster Energy at 36, 37% market share, super strong. Red Bull is pretty much right behind them at 35%. And then we have Celsius with 5%, 5% for Pepsi, and 3% for Bang. So really, Monster and Red Bull are the two big players there. And here's another Google Trends chart showing you that Red Bull is actually slightly more popular. Pretty much over the last 5 years, Red Bull has been pretty much more popular the entire time. But Monster Energy is right behind them. Then we have like Zoa Energy and Bang Energy. As you can see, they're all the way down here. They still have ways to go if they want to catch up. And then again, if we're looking at how they're innovating, they also have other brands like Reign. And then they have oat milk products, zero sugar products, all that stuff. Here we have a Monster Mule drink. So I would consider them innovative. The market share is very strong. One thing to pay attention to, though, is I think that one reason they might be having trouble growing their net income as fast as they used to is because of all the competition now. Because when they probably, in 2005, 2010, there wasn't all these players there. But now we have the Zoa Energy, the Bang Energy, the Red Bull, all this other stuff. So return on invested capital, also a super strong number for this company. I was very happy to see this. We're looking at anywhere from 20 to 30%, which is better than most companies, 21% last year. And although it's been declining for the last 5 years from 32% to 21%, let's hope, it doesn't fall too much more. I mean, look at them, back in the day, 70% ROI. So, but 21% is still strong. That's really nothing to worry about. If it came down to like 10%, then it might be a concern, but right now it's fine. Growing equity, yes, nearly a double in their equity in the last 4 years. It's now at 7.8 billion. So they're doing a great job there too. This is actually, when I looked at this balance sheet, this is one of the best balance sheets I think I've seen. Although the equity is not 15% of the market cap, it's only like 12% or something like that. That's just because this is the valuation's high. Anytime you have a fast growing company and it trades at a high PE, high price to sales of, let's say, 30 times earnings plus, it's not going to have, most likely it's not going to have 15% of the equity or 15% of the market cap in equity, but it's close. And everything else with this company looks phenomenal. There's a reason it trades at such a high premium. Share count decrease, it's pretty much flat, but it is decreasing by like a fraction of a percent. So I put yes. Once again, here's the balance sheet. The assets are 2x the liabilities. They're actually 9 times. So this is probably one of the best balance sheets I've seen, because most companies cannot do this. Most companies do not have 2x the assets that they do in liabilities. This company has over 9 billion in assets and only 1.4 billion in liabilities. That's amazing. You don't see that ever. So that's one of the best balance sheet ratios I've come across. Profit margin over 10%. Yes, we're looking at 18 to 30%. Again, I think this is another number that's like slowly declining. So we're looking at 30% in 2020, then 24, and now we're down to 18. Once again, slowly declining, but definitely not bad. 18% is strong. That's not bad at all. Cash receivables are $4 billion, which is more than their average annual income of about $1 billion. So that'll get a check. No dividend for this company. It's founded in 1990, so they've been around for a while. It looks like they really started picking up in like 2010, 2015. That was probably when they were really picking up. And then even since 2020, from 2020 to 2023, the stock has nearly doubled. So, or the stock has more than doubled actually since 2020. So they're still going strong. Their numbers are strong. The balance sheet is amazing. The market share is amazing. The main thing to keep an eye on for this company, I would say, is the competition, to see how much market share can they take away? Will Monster Energy buy out some of these other competitors, or how is this all going to happen? And then lastly, we have free cash flow growing. In general, yes, over the last 20 years, they've done a great job. But again, the last 2 years, it has declined. So let's hope this isn't the start of like a new trend of them going downhill. But as you can see here, they normally were growing at about 10-11% per year, and it peaked at 1.3 billion in 2020, and now it's coming down. So, and it's back to where it was in nearly 2016, 2017. So we'll see what happens. I mean, we'll see if they buy out competitors. Will the competition take away their market share? Will this company come out with new products to, stay afloat here? But if this stock traded down, let's say it fell 20%, 30%, I would be interested in buying this, because anytime I see those numbers, anytime I see a balance sheet like this and a return on capital number, a profit margin number like this one, then I'm super interested. But I'm not going to pay 40 times earnings or 38 times earnings when it normally trades at like a 30 to 35. So if this came down to this level, I would say anywhere around this level of about $50, that's where I would be interested. This $50 to $55 mark, that's where I'm interested. So, well, I guess it doesn't really even this isn't a very volatile stock. Yeah, I would say around 50. I mean, over the last 5 years, you could say it underperformed because it's up 83%. Let's see what the QQQ is up. In the last 5 years, we're looking at 100%. So it's slightly underperformed. So that's why you'd really have to get this at quite a discount. I think this company is kind of more of it's in the maturity stage more. So you really got to be careful with where you're buying it. I wouldn't want to pay 40 times earnings. But yeah, that's the way I'm looking at Monster Energy. I'm super impressed with the balance sheet, and their numbers are really strong. I guess just watch out for the competition, and let's see if they can turn around all their numbers, the free cash flow, the net income, all that stuff. And yeah, thank you for watching. I will see you in the next video.